Right, good morning everyone and welcome once more to Innovation Bay's Wednesday morning event series. I'm your host again, Ian Gardner. I'm a co-founder here at Innovation Bay. I'm also a VC investment partner with Ulric Ventures. Also, I always give a call out to the Innovation Bay team. We've got Faden Stow, my co-founder in Hobart. Stay warm, buddy. I think there's a bit of a cold snap coming through there. Shan, Claire, Sam, CJ and Alison. So yeah, our little team is growing. Very exciting. We're all working pretty hard to support and connect the startup community across Australia. So look, thanks everyone for joining. Special hello to all of those tuning in from Victoria. You know, we're not really sharing your pain, but I guess we understand it. It's not much fun getting locked up. So I hope you guys get through it okay and come out the other side stronger. For those that may not be familiar with Innovation Bay, if you're new here, we are the longest running community for founders and investors across Australia. Our mission is to support founders on their journey from idea to IPO and beyond. We do this using events, programs, content like this, designed to enable people to connect, learn and grow. Those are the principles we stand by. Big thank you to our sponsors. We couldn't do any of this without them. So IAG, Farmark Ventures, AWS, KPMG's High Growth Ventures team and Macquarie Bank. They offer great support to us and across the entire ecosystem. So check them out, give them some love, use their services because they really support us. All right, so today, look, fundraising is always front of mind for all founders. You know, I think we're all freaking out a little bit back in March. I mean, the reality is it's tough out there, but it's, you know, there is cash still there. There are deals still being done. So you can find some funding if you have the right approach and the right team and the right business and all the rest of it. So loads of questions. We thought rather than, you know, me and us as the team coming up with a whole bunch of pre-filled questions, we'd turn the mic almost over to you. So you, the audience, have the opportunity to ask your questions. Many of you asked questions on the registration process, so we've taken them. So we've got some really good questions that we can get kicked off with. During the event, we have the chat running and we have the Q&A function running. So if you have other questions you want to ask, we've got 3 of the best VCs in the country who've joined us. So let me switch off my screen share and we will go and meet our fantastic panel. So let me just give a quick intro to all of them. Hannah Field, principal at Tempus Partners. She's been on the mighty Open the Pod Bay Doors podcast. I think you were one of the last ones I did this year before the lockdown started, Hannah. So Hannah's got a really interesting career. She's been with high growth technology companies, including Dropbox, Pandora, and she was one of the first employees with Canva that you may have heard of. She headed up business development operations there, and she's helped Australia's best technology companies secure amazing engineering talent in her prior work at Lookahead Search. So she's done some recruitment work too. Welcome, Hannah. Grant McCarthy is founder and managing partner at Tidal Ventures. Grant's been a VC for a while. Tidal's relatively new, so it's a really cool VC. Just announced a $30 million seed fund, so plugging a gap at that seed stage. So a pretty interesting model there, which I'm sure we'll hear more about. Grant followed his passion for digital media, and he had a role at Yahoo all the way back in 1999. He doesn't look that old, so I don't know how he had a job that young, and stayed through to its investment in Alibaba. And yeah, you've been investing at the seed stage for more than 15 years across Asia and Australia. So welcome, Grant. And then finally, Ulric Ferner, as principal at Right Click Capital. Ulric's got a PhD in computer science and a master's degree in Aeronautics and Astronautics, so you must be extremely clever. You joined from Boston Consulting Group. You joined Right Click from BCG. You're a specialist in evaluating investment opportunities and IP with a deep understanding of the Asia Pacific marketplace. Yeah, last time I saw Ulric was on a squash court, so he's part of the VC squash community. So yeah, welcome Ulric. So fantastic to have all 3 of you. Let's do a quick mic check. Are you guys all coming through all right?
Yeah.
All right, good.
Yeah, sure, thanks.
Right, well, should we jump in now? Before we started, we thought we'd try and keep this a little bit interactive. So we thought we'd throw up a poll. and see what the founders are thinking, see whether you founders out there are thinking the same as the VCs. So the first question, what do you think the first criteria that VCs will take into consideration when they're trying to make an investment? And then once we've asked that, we will throw to the panel to give the correct answer, which I suspect will be the same. So once you've done that, press submit, and we'll see what the audience says. I think Claire's going to throw up the answer for us before we get to it. So Hannah, I'm going to jump to you first.
Yeah.
Well, once we'll hopefully get an answer here. Claire, is it
Okay.
is it coming, or should we just jump on with? Here it is. Yeah. So team is first, traction second, revenue, purpose and innovation.
Yeah.
Following up to
yeah.
Cool. So do you want to give your expert perspective on this one?
Yeah, and I promise I'm not giving the biased answer here now that I've seen the audience response, but I think for us, certainly, when we go through our criteria looking at a business, people and team and co-founders is really top of the list. Really want to be looking at highly ambitious individuals who are sort of doing their life's work, have really unique insight into the domain that they're building a business in. If they're a co-founding team, do they have complementary skills and experience, deep insight into the sector and really understand their customer. So yeah, absolutely. I think team is super critical.
All right, Grant, how about you? Any different perspective on that?
Team's obviously really critical or high in the list. I think probably the only thing that I'd say is what we also focus on, depending on what the definition of it is within the poll, is purpose. We're very, very strong around sort of a thematic that a founding team is trying to solve a problem within.
You mean, is it your life's work?
Is it your life's work? Is it your passion? Is it all of those things, right? So purpose scores really high on our sort of initial, and particularly because we're obviously investing at that, right from early seed, so just post angel through to sort of seed extension rounds. And so a lot of things are, just both unknown unknowns and known unknowns at that time for those businesses, right? So having that strong determination and purpose around what problem they're solving for a market overall is a really critical thing for us.
Yeah. Ulrich, anything to add in this?
Yeah, look, maybe I'll be a bit contrarian and say that I actually think there's no single thing. Every company truly is unique. Right click, we do focus on the seed stage as well. And so I would actually say that team and purpose are very tightly coupled, and those are certainly two very important ones that we look at. We look for bold founders with a truly unique vision for the sector. So one of the questions, for example, that I often ask founders is just what's something that you believe in your industry that most people in your industry do not believe. So that's a big thing that we focus on. And then of course, yes, just to echo, team also matters, of course.
Right. So it sounds like it's not like you've got a pro forma of these are the questions we're going to ask, but that's an interesting one. I've heard other VCs ask a variant on that. So is that you will always ask that question of founders when you meet them, Ulrich?
It's probably one of the most common questions I ask. Sure.
Right. All right. So, I mean, the other way around, and Hannah, I might throw this one to you, but do you find when you meet founders, they always ask you the same or similar question? Is there one common question that you're always asked?
Yeah, I was having to think about this because I know you sort of posed that to the panel earlier. To be honest, I think probably the top question I get asked is a very boring question, which is sort of very tactical. What's your average first check size? So to be totally transparent, I mean, most founders are going to ask that because they just want to sort of understand, do they fit into sort of where we're investing and sort of that seed stage. But I think probably the second top question is sort of, how does Tempus work with portfolio companies? What is the experience like to be a Tempus company? And I'm sure Ulrich and Grant probably get similar questions as well. Yeah. So that would be the more sort of substantive top question that we get from founders.
And is it, I mean, because it's always a bit of a dance when you're first meeting the founder, especially for the first time, but is there a tell that you've got? So the way that the founders engage with you and ask questions, like, do you almost know based on that and the way that they're engaging with you, whether or not you're likely to invest?
Yeah, definitely. I think founders often think that VCs sort of sit in ivory towers and they have to do this perfect pitch of who they are and what they're building. And the reality is, this journey is a 10+ year journey. And, there are a lot of relationships that don't even last that long. And these are investors that sit on your cap table for a very long time. So we really want to understand and sort of peel back the layers of the facade and understand what keeps them up at night. So a question that I often ask founders is what really freaks you out about building this business and operating in the world that you operate. And I think sometimes founders are quite reticent to share their vulnerabilities and what actually worries them. And if you can't build an open and transparent relationship with founders up front, that gets really scary when you're sort of 3 years down the line, 5 years down the line, and they're not necessarily being open about the real challenges in their business, and we don't understand how to help them. So I think having those really open conversations from day one is super important. And my job, in those conversations is to really tease that out and build that relationship and rapport.
And Grant, that early dance, as I talked about, is there any common threads that you find that is going to be
probably more so one of the almost behavioral things that we look for within founders, just because the nature of what an entrepreneur is and needs to be like is just their inquisitiveness. So when they start asking you questions about, how does your fund operate? What's your background as a VC? What businesses either have you started or been successful at in investing in, et cetera, they're really good signals to us around, not only just the personality type of person, but their general inquisitiveness and trying to understand more. Because at the end of the day, when you're pitching a VC, like in any, sales environment, you're asking a bunch of questions to learn more about actually what this VC needs to understand about me and my business and the market I'm going to penetrate in order to try and convince them to invest in me effectively. So that dynamic part of the Q&A up front is a really important signal, rather than just sort of the, what's the check size you do, what rounds do you follow on after seed, what are you seeing valuations in the market at the moment. All those kind of things are just, they're more tick the box kind of things, but it's really your engagement level and how you form, a conversation and ask a broad set of questions to a VC, I think becomes quite, it certainly gets you through further into the process for sure.
Yeah. And it's interesting, you mentioned that sort of sales process, and in some ways when, founders meet a VC, it's almost the founders are selling more than the VC is, the VC is listening. But at a certain point in that conversation, it does flip. Ulric, I might throw this one to you, but because ultimately, a fantastic founder is going to have, not quite the pick of the bunch, but there'll probably be a little bit of competitive tension in the relationship. So
sure.
VC then goes into the sales mode, saying, "Oh, aren't we great?" So do you want to just give your observation of that dynamic and how that plays out in that, first meeting to investment timescale?
Yeah, look, I think it certainly has to be two ways. So you're looking for fit between the VC and the founders. And in particular, when it comes to, I'd be very careful or cautious if a VC is also not trying to explain to the founder how they can help those founders and help the company beyond just the capital, which is frankly a commodity. And so I'd certainly encourage founders to really try to unpick and understand, how do you as a VC, or how does that VC help the founders and the startups that they work with?
Yeah.
And if the VC can't answer that should make you nervous.
Mm. I guess adding to Ulric's response, really tangible examples, can actually speak to, here's what we did last week, or here's sort of where we weighed in the last board meeting. And I think founders should do their due diligence, right? There's a whole portfolio of companies with founders in them. Reach out to them, send them a message. And for us, we're very happy to, as we sort of navigate down the relationship, because we don't want to overwhelm our founders, but, we get to a pointy end and there's sort of really strong mutual interest in partnering together, making those introductions to existing founders so you can get a sort of inside perspective of what it's been like to work with us. So I think
Yeah, sorry, there's a related question came in during the registration I might throw to you from Ross Hardy saying, how can founders perform quality due diligence on the investment in terms of their lives versus espoused values? So I guess, maybe just extrapolating a little bit more on that on founders to VCs due diligence.
Yeah, absolutely. I mean, I like the wording espouse values because there's sort of tweets and Medium posts, et cetera. But I think where you can get really honest feedback is talking to founders in the existing portfolio. So I've certainly spoken to founders where, we've gone in a couple meetings and then sort of I've learned that they've spoken to some of our founders about us. And I think that's fantastic. Like they've sort of gone through that effort to reach out and want to have a conversation about what it's like to work with us. Likewise, talking to founders who have been rejected in the process, I think is also really insightful. For us, we take a lot of pride in making sure that we have real conversations with founders. If we're choosing not to invest, it's not going to be an email that's sort of flicked back with a generic no. We try to give really substantive, thoughtful feedback. And so I think even the rejected founders in the process can share a lot about the experience with us and what did they gain from the learnings through the conversations they've had with us. So I think that's sort of another way that you can do a sort of different angle of DD.
Yeah, I mean, just on that.
Maybe just to add to what Hannah mentioned, when doing diligence on an investor or doing reverse DD, yes, of course, take those introductions that they give you to the certain portfolio companies. I would also encourage founders to reach out to portfolio companies that the VC has not introduced you to. So cast a wide net, and ideally you talk to founders for whom the business has gone through some really serious challenges and try to get a feel for what the investors like to work with when everyone's under a lot of pressure.
Yeah. I just wanted to unpick that rejection process. I mean, because I think all of you, all of us see a huge number of applications, if that's the right word, for funding. So, I mean, Hannah, I completely understand. Like, if you go a long way down the process and you've had deep engagement and spent a lot of time with them, it's kind of easier to give a educated, let down, if that's the right word. But do you do that as well for the, fairly unsolicited, team at tempuspartners.com emails that come in?
If we've given a first meeting to a founder, I'll pick up the phone and give them 10 minutes and let them know it's a no. In my mind, I know this isn't the case across sort of every firm and this is just a personal view on the matter, but if they're giving us their time to pitch to us, and even if it's sort of a 30-minute chat, I'll either tell them sort of at the end of the conversation if it's clearly not a fit, if there needs to be some sort of light assessment or just flagging with the team, and ultimately the answer is no, I will pick up the phone and give them a call and let them know and just sort of flag to them sort of the key reasons of how we were thinking about the business and why it's not right for us.
Yeah. All right, let's keep rolling with our audience participation. Kirsten McIntosh, thanks for your question, Kirsten. What do you think the founders nearly always misunderstand about VCs? Grant.
Good question. Look, there's a bunch of stuff, but probably the key one is actually, so, when you're pitching to a VC per se, once again, like you're normally building a relationship with a partner or a principal up front in that firm, directly kind of thing. And one of the things I think what a lot of founders don't understand is that there's still then, partners and others sitting behind that person in the VC firm, and particularly this thing called a investment committee. And so, what you hear sometimes from the individual you've been pitching at might necessarily be consistent with what other people in the firm are thinking about a sector or a business type or a business model or whatever it might be. And so actually trying to, sometimes ask questions further deeper than past the person you're engaged with, or even, we just spoke about catching up with founders of other portfolio companies, actually asking if you can, go and have a coffee and meet up with other partners in the firm is probably a really critical thing, because, what a lot of people I don't think understand is when, I'm, even though, managing partner of the firm, I take a deal back in, that deal gets critiqued by our investment committee, and I have to make sure it gets through that process, and they'll have their own, you know, not necessarily completely different points of view on things, but they'll have their own questions and ideas and assessments of a sector and a market. And so, you know, it's really important that founders sort of understand that there's a broader set of people behind these decisions, and trying to reach around and talk to some of those people, which I know is hard sometimes time-wise, but it's a really critical thing.
Yeah. All right. So, I mean, I think what we'll do with these questions is I won't ask it to all three of you. I'll just kind of go with one. But if either of the other two really want to jump in on it, just please do. This question just came in this morning. In fact, kind of two, but they're the same question, I think. So it's around solo founders. Nathan Franciscus, for a first-time solo founder, seed fundraising can be difficult. What minimum level of traction do you expect to make up for deficiencies in other areas? And then there's an anonymous question saying, what's your opinion on solo founders and their chances to raise? So yeah, observations on solo founders. Ulric, I'll chuck this one to you.
Sure. So we are very open to working with solo founders. And what we usually try to look for, though, is that in the team, whether the team is one or more people, we're looking for many different things. And so, for example, if it's a technical business, we're looking for some technical expertise as well as that commercial acumen. And so I would say if you're a single founder, the bar is probably a little bit higher, because we'd be looking for folks that have an unusual mix of many qualities, as opposed to spreading it out across the team.
Okay.
But totally open to solo founders.
Hannah, your opinion on solo founders?
Yeah, we would be the same in terms of solo founders. I think I do agree with Ulric. You know, the founding journey is extremely difficult, and doing it on your own is incredibly difficult. I think the one thing to add to Ulric's comment is having that magic around attracting great talent. So no one's going to build a business in a vacuum. You still have to bring people on the journey, and the ability to sort of tell a compelling story about why you're doing what you're doing and why others should come along that ride and build with you, I think is super important. You're going to need incredible talent alongside you, even if those people aren't founders, but part of the founding team. You know, I would say that's sort of the other X factor that we'd definitely be looking for if you're a solo founder.
Yeah, I mean, with your recruitment background, I guess you've got a bit of an insight into how hard and important that is.
Yeah, definitely. And I think, you know, for founders that are tuning in, who have sort of few years down the line, everyone makes mistakes. Every founder inevitably hires the wrong people at the start. In some areas, you know, I think pretty consistently, like the areas that we see challenges is like hiring your first head of sales or your first head of marketing. And these are often very nebulous disciplines that become difficult to identify the right talent that fits sort of the business that you're building, the market that you're going after. So yeah, I would say it's extremely difficult. Don't beat yourself up if you get it wrong the first time, but if you realize that you get it wrong, correct it as fast as possible. There's no sense in sort of dragging people along the journey who aren't right for the business. So
yeah, I mean, it's such an important dynamic, that co-founder one. I mean, it's Grant, I'll chuck this to you, but I mean, there's so many examples of great company. I mean, think of Atlassian. I mean, it's unbelievable. Those who are still as talented and equivalent, if you like. I mean, they've grown at the same pace, it seems, and they've managed to combine that CEO role, which is unbelievable. But there's many examples of startups that will just blow up because the co-founders either can't get on, or they haven't got their agreements right, or I mean, any insights on it? Because it's a double-edged sword. You know, you want a co-founder, but you kind of don't. I mean, it's
yeah. I think Hannah said it, like these relationships in these businesses are meant to last a long time. And so, you know, it's horses for courses. I think, you know, everyone obviously always starts out with best intentions around when they start a business with a partner, whether it's one or two or three, like two or three or four. I think what our learnings have been along the way is that it is very rare, like you said, to find a couple of founders that sort of capability-wise complement each other almost perfectly, or are able to grow in capability at sort of the same rate, or at least close enough that they're able to continue that journey together. What we have tended to see, if that doesn't work, is, you know, one of the founders tends to be, you know, ending up being the leader of that business, and the co-founder might step back into a board role, for example, or an executive role within the business, where they realize they haven't been able to get up to a level of capability that's required by the business at that point in time. But, you know, it really depends on the scenario that builds out and how successful the business becomes.
Mark Sarin in the chat said even Batman had Robin.
Exactly.
That's kind of a creepy relationship, so I'm not sure that's founder, co-founder.
We won't go there.
Robin, maybe.
All right, let's keep going. So here's a little bit inside baseball question, one from Grant Treen. How do you see the secondary market for startup investments developing over the next decade? And then maybe I'll throw to you, Ulric, on this one, just explain what a secondary market is first.
Sure. So secondaries are where in a private company, generally, shares are being sold where in that transaction, new shares are not being issued. So existing shares are being sold from one party to another. And I'd say at the sort of mid stage for startups, the secondary market's still got a long way to go in Australia. So it's nowhere near as sophisticated as the US for sort of Series B to pre-IPO companies. You don't really have the equivalent of US players like, let's say, Forge, which are even platforms for secondary share sales in private markets here. But certainly expect in Australia the secondaries market to get much more sophisticated in the coming decade.
There's some secondary funds being either raised or raised. Grant, you're nodding, so I might throw this one to you. I mean, like, any insight on this secondary piece?
Yeah, I think what we find is, and it's an evolution of the market as what's happened in, you know, the US over the last 40 years, I guess, but we kind of see it splitting into two areas for secondary. So one is what we would describe as sort of more institutional secondary, and that can be related to both funds and companies and staff within companies. So if you look at, you know, Blackbird's strip sale of their GP part, I mean, that was a big institutional secondary fundamentally, but for a fund manager in the sector, versus companies, as Ulric said, you know, we generally are seeing sort of no earlier than Series Bs here where a secondary might happen. And generally why that's happening in our view is because, you know, a company will say, okay, Series B, I want to raise $20 million into my business, for example. And the institutional fund managers are sitting there going, well, you know what, guys, like I've got, you know, however many hundreds or billions of dollars. I want to write a minimum check of sort of $30 million, and plus the company still has to fill their preempts on the round as well, right?
Yeah.
So you get this sort of natural tension of like, there's actually, in the good ones, more money available than what's required because, you know, good Aussie tech companies are very capital efficient. And so you end up shaping the round where you might then make it a $30 to $35 million round with $20 million in a secondary fund, or the institution then buying some shares out of the founders or executives who've been there a while, or the early stage angel investors, because you want to sort of consolidate the cap table a bit. So, yeah. I mean, we saw that in our Predict HQ Series B in the US already, and we're seeing a couple in our portfolio looking at doing that at the moment from a Series B perspective. So we think it's going to be much more common.
Yeah, I mean, overall, it's a very healthy scenario because, you know, you're getting the early, it's not just the early investors being given an option to exit or partially exit, but it's the early staff as well.
Yeah.
If you're, you know,
well, you look at the recent SiteMinder transaction with BlackRock, right? There was a very decent portion of secondary in that deal.
Yeah, and safety culture too. I mean, the last round mostly went to staff, I think, which again is super healthy because you're seeing new angel investors come around. Some, you know, it's great having equity in a company, but certainly in Australia, maybe I'll ask you this one, Hannah, because you've had US experience too. But in the, you know, if you talk to founders in San Francisco, you know, very early in the conversation with a potential staff member as well, what's the equity component? That's not a conversation that's had so much here. And I think part of that is that there's been historically no successful, oh, I'm going to get rich by joining this company, because there's historically been limited exits or ability to liquidate your share options. So is that changing?
Yeah, I mean, I definitely think in Australia it will change. I mean, I think it's important to sort of understand why this dynamic is evolving the way it is, which is, more capital in the system invested in sort of mature growth stage businesses, and with access to a huge amount of capital, you can actually stay private for longer. And so you're seeing exit horizons extending beyond where they were even 10 years ago. I was reading a stat recently where I think it was unicorns hold something like 900 billion in illiquid value right now. And that's like an astronomical number, but it's sort of locked up value. And obviously there's the benefits for investors in venture and sort of realizing that value. But I think, Ian, you've touched on the benefits for employees. And I think that's so powerful to be able to give them a platform to benefit from those early years that they've poured in, often way below market salaries, sort of sitting on a stock that they can't really do anything with. And so looking at the ripple effects of if they can realize that stock and sort of sell it in a secondary transaction, what does that mean for them? Maybe they can build their next company or be a founder themselves or start seeding, doing angel investing. I think there's like sort of second order benefits to giving early staff the ability to realize those returns. So just calling out sort of one that comes top of mind is second quarter ventures. I think they've done a phenomenal job, and hopefully we'll see more of that in sort of early employees at Canva, Culture Amp, Safety Culture. These are really mature businesses with a lot of value there, and seeing sort of that next generation of employees be able to do something with that capital.
All right. Thank you. Let's keep rolling on. Ulric, I'm going to ask you this one as the most academically credentialed and most intelligent amongst us. Well, hopefully. Marie Baer, how do VCs educate them about new sectors, for example, health tech?
Sure. Great question. First of all, VC is actually a very weird role because you have this strange advantage that you talk to a lot of people. So, each of us look at literally thousands of companies a year. And then VCs, we do a lot of internal thesis work where we are essentially trying to understand to what degree are the ingredients for rapid change, or to what degree do those ingredients exist in different industries and verticals. Yeah.
All right, let's keep rolling. There's tons of questions, so I am going to try and maybe up the pace a little bit. Grant, I might throw this to you because I know that you are a data junkie. Adam Ingalls says, what would you say are the main mistakes founders make with their finances early on?
Cash flow.
Running out of cash? You only do that once?
Just cash flow. I think one of the anomalies people think about startups and whatever is that they're a unique business, but they're just a business and they're a small business. And so, yes, you've got a P&L and a balance sheet, and obviously there's not too many assets sitting on a balance sheet in a startup. But cash is everything. So just monitoring and managing cash flow and understanding how you build a proper sort of cash flow model for your business is something that always not surprises us, I guess, but just it's a discipline and a capability that a lot of startups struggle with, like actually aligning product development with some basic go-to-market and what I'm going to achieve from a sales or traction perspective and how that plays back in to a length of time or a runway that I've got capital for, kind of thing.
And so when there's two elements to cash flow, you've got revenue and expenditure, and I guess you've got funding and grants. But
funding and grants, the whole kit and caboodle, right?
Is there a weighting that you'd suggest that they should be focused on, like revenue or spend?
I don't think it's so much ratio. It's just it's an actual critical understanding of the timing of your cash flows. So, for example, the classic one always is, okay, I'm going to claim my R&D this year. And it's end of tax year, and all of a sudden I'm going to go and claim it, but I haven't done any of the work to actually put in my R&D claim. And so that's still sitting there in October, and it's Christmas. And so I'm not getting it till January, rather than I'd forecast it back in my budget to come in August.
Yeah. All right, well, let's keep rolling. I do want to try and get through as many of these great questions that are coming in. Hannah, I'll throw this one to you from Oliver Feng. Besides money, what else can VCs do to help startups? Great question.
Yeah, really good question. I would say that support outside of capital typically falls in a few kind of key buckets. One is just helping them with team building. So this can be introductions to great talent. It can be, helping them think through the strategy of building the company they need to achieve the milestones that they're going after. So where are the gaps on the team? What sorts of profiles they're looking at? Sort of expanding the executive team as well. I think sort of second bucket would be customer acquisition. So again, introductions can be super valuable around, key customers, particularly early on when you're talking sort of pre-seed, seed stages. And, understanding how to build that customer acquisition engine is really important. That's going to vary depending on sort of the business model, sort of product that they're building. And then I think the third area, which is pretty broad-based, is just developing operational expertise. So how do I actually run a company? How do I enter new markets? How do I release a new sort of core product to our existing product suite? I mean, there are like a million questions that founders are juggling day in and day out, and just understanding how to make really great decisions from an operating perspective is super important. So I think in the DD process, which we touched on earlier, asking a potential investor how they can help in sort of key buckets that enable them to build a really successful business is going to be important.
Yeah, and it is an important point. I mean, like any good VC, which you guys will all be in, like you want to add value to your investees. You don't want to be dumb money, because part of the reason we do what we do is because we love helping, and you can't really help if you don't have any expertise. So that, there is tons of things that you can do. Startups. So those are good questions that should come from founders to VC. What could you do to help me?
And just adding to that, like the help can come in different sort of channels. So I think sometimes founders have a view that it's like, requires the investor to be operating at a board level. That's definitely not the case. And so understanding, like outside of sitting on a board, if they're not at the stage where they actually require a board very early on, what does the communication look like? What's the cadence? What's the style? Is there an open door policy? What can they anticipate from those interactions if it's not sort of in a very formal sense? I think, asking a lot of questions around that can give you a good sense of what the experience will be like.
Yeah. All right, thank you. Keep rolling. Milosh Lee, I'll throw this to you, Ulric. What are the minimal requirements for you to consider funding around team, traction, revenue, etc.? Yeah, so throw that one.
Okay, well look, we are a very early stage fund, so we do a lot of pre-seed and seed stage investing. And so we don't have a lot of requirements. A company does need to be incorporated, and we have a very strong preference that at least one founder is full-time. That's it.
A strong preference, but that's not a requirement?
Correct.
Wow. And Grant, on this one, I mean, you're a super early stage investor too. Like, what are your minimal?
I mean, we'll if I think about a distribution that we'll do in the new fund and sort of compare it to the first fund, we'll end up looking at things that are definitely pre-revenue. It won't be the bulk of the portfolio at seed stage that we invest in. So our kind of sweet spot is what we'd call sort of that mid seed point, not early seed, but effectively, has a product in market, has some revenue. So B2B SaaS business, maybe they've got something between 20 to 100 customers, something like that. Because what we're trying to understand is some basic signals around the problem they're actually solving for customers. And if you've got a product there and people are paying you for it consistently, you mightn't have figured out a bunch of things around the business and the market, but it's saying that you're doing something for a set of customers who have a problem that you're doing well for, kind of thing. So we'll go from there through to, like I said, early pre-revenue through to that to sort of seed extension where they're sort of heading towards a Series A probably within 12 months and have got a bunch of sort of economics figured out around the business, but need probably that extra 12 months to bulk up some team and capability, etc.
Yeah. All right, let's ask a question about the TAM. So there's three things really that you think of when you're looking at potential investment. You've got the team and their talent, the ambition of that team, but it's got to be combined with a huge market. So we've all seen those pie charts where it's global market is 100 billion and we just need 1% of that. We've got $1 billion business. So let me just read the question. It's from Kim Chandler McDonald. Frame your TAM opportunity as huge, or be conservative, because no startup does get 1% of the market. What is your preferred approach to see when it comes to this elusive market size slide, Hannah?
Yeah, I have to say, if you're, I don't know, just picking a random business, if you're telling me that you're building an e-commerce business and you're going to sort of own a $1.5 trillion market, there's just sort of a lack of believability, and it feels sort of highly inflated. And so I think what we're much more interested in, and keen to hear Ulric and Grant sort of weighing in on this, because I think everyone's going to look at it differently, but just understanding the sequence of how you actually capture a market. And I'm much more interested in understanding, like, what is the niche market? What is the wedge that you're going to dominate? And then how do you grow that wedge laterally? And so what are the adjacent opportunities? Like, what is sort of the core opportunity that you're solving for? And then why is that going to Trojan horse into a bigger opportunity? And so sort of building it from the ground up, understanding sort of how many customers are in that opportunity, the likelihood for them to pay, what is your, like, sort of realistically, can you actually support them? And sort of what percentage of the broader market can you acquire in sort of 5 to 10 years? So I think, and these don't have to be elaborate slides, but I think the sort of top down, we're going to dominate $100 billion, $1 trillion market is just, it's just, there's no context and framing around that. And I really want to understand, you start from zero, and how do you own the wedge? And then how do you really move laterally and own a much more substantial market beyond that?
I've got to say, the pitches that we see, the market size is always the one that we're sometimes left scratching our head. It's like, so that's normally the one that when you first talk to them after seeing the pitch deck, you'll have the most questions on. So maybe just quickly, Grant, and then Ulric on the market size and how you want to see it. Grant?
Yeah, so a bit like Hannah said, it's all about your segmentation of the market. So, you start, e-commerce is a good example, actually massive market, but what problem and what segment are you going to solve that problem in first, to become famous for that, to earn yourself the right to go beyond that segment into the next segment, so to speak. Yeah. And we've seen that, it's a thing we challenge companies on, and the way we kind of frame it is, like, all of us will sit there and ask you, how are you going to get to 100 million in ARR, right? That's your challenge. That's the problem you're solving as a business. So unless you can actually kind of structure a bottom-up market segment framework to achieve that level and understand sort of within each segment how many customers there are and your competitor sets and the unit economics you think you can drive out of that and the value you provide them, etc., then you don't really know whether that 100 million in no matter what size market it is achievable or not. Yeah. Starting with the market, segmenting that really well, understanding that particular segment that you're going to execute within that problem set and become famous for is the first step. And it's fine, put up the big pie chart and it's big and whatever. But right next to it, say, here are the 1 or 2 segments I'm focused on first.
Yeah. Ulric, any insights or good stories or horror stories about this one?
Yeah, look, I agree with everything that's been said on this point. And one thing that we sometimes see founders do is that they will mix up their TAM with the size of their market category. And so just for the founders on the call, just be aware that VCs tend to think about TAMs as aggregate revenue potential. So you have to almost try to align the TAM to your business model. So for example, if you're Uber and simplifying things, you wouldn't say that the TAM for Uber usually is the entire taxi industry. They have because of their business model, they have a take rate. So you'd say, for example, that it's the size of the taxi industry times, say, 20% the take rate. Yeah. So just make sure that you align TAM with your business model.
Yeah, but definitely think about it. I mean, we saw a pitch once that they were going to get 1% of global GDP. And you're like, okay, well, let's It was ambitious, let's not be too critical of it, but there was no real substance behind it. So as long as you're thinking about it, I think is the punchline here. All right, let's keep rolling. Naden Franciscus, in with question 2. Naden, does being in an accelerator like Y Combinator, 500 startups, or, well, he hasn't really said StartMate, but we'll add that in there. Does that make you more appealing to an Australian VC, Hannah?
I would say we don't weigh you any more or less if you've been through an accelerator program. I have only great things to say about StartMate. I've been working with them for the last couple of years as sort of an active mentor, and we've actually backed 3 StartMate companies. But I think to gain investment from us, being part of an accelerator program is by no means a prerequisite to get investment. I think it can be valuable if you're just starting out and you're looking for sort of broader support and you want to tap into a valuable community. There's huge value extracted from communities like that.
Yeah, I might just get a quick answer in this from the other 2 as well. So Grant?
Yeah, look, the one advantage I definitely think it provides is it's a great fixed short-term education process for how you need to think about positioning yourself for capital, right? The language, how you set your decks up, how you create that positioning and story and problem solving, and what my business is going to be and how I execute it. I think there's really valuable insights and learnings that those accelerators provide to businesses. Yeah.
Ulric?
Yeah, I think for some founders, accelerator programs are fantastic, and for other founders, they don't need it. I'm definitely with Hannah on this one, that it doesn't change how we look at a company at the end of the day.
Yeah, no, that makes total sense. I mean, in some ways, our observation is that there's a little bit of a premium. There's like almost a StartMate premium. I mean, a StartMate company coming out at the similar level to a non-StartMate company can often demand a slightly higher valuation, is my observation. So there can be some, I don't know whether it's normally good for the founder, I suppose. But again, it's fairly neutral, I think, is the answer. Yeah. All right, let's pick another question. Mark Domkins, what are the ingredients, cultivation of your VC ecosystem, for example, within Tempus, so I guess it's to you, Hannah, that you believe most contribute to the growth of your founders and their companies? Yeah, so like, how do you bring your portfolio together to help them help each other, I guess is what he's saying.
So sorry, what was the question?
It's kind of, yeah, how do you get your founders how do you build a community within your portfolio that will, a rising tide raises all ships? Yeah.
So we have a pretty tight-knit portfolio. We've got 14 companies, and we do it through a variety of ways. It actually happens quite frequently where we will introduce founders to each other. Sort of similar stage, solving very similar problems, might be in different markets, but giving them a chance, because we have such deep insight into those businesses, understanding that it would actually be really valuable to connect 2 founders one-on-one and for that relationship to spin out from there. We do internal events as well, so connecting founders with each other, for example, during COVID, things like mental health and wellness, and how are you supporting your employees during a really I guess scary time that frankly no one had ever experienced COVID before. So getting them together in sort of a closed environment so that they could be really open about the challenges. How do I deal with potential layoffs? These are really tough conversations, and you don't necessarily want to express that in a very open kind of environment. And so being able to facilitate those sorts of I guess vulnerable conversations is something that we do, and sort of through internal events. Yeah.
All right. Look, we've got about 5 or 6 minutes left, so we'll just try and rattle through a few more questions. Johnny Wapstra, do the panelists watch pitch competitions like Climate KIC, Climate Launchpad, I guess StartMate and Antler and all the rest of it? So Grant?
Yeah, we watch them and participate in them. I think, look, there's no doubt the accelerator programs, et cetera, have been awesome for the sector overall. But a bit like the other guys were saying, right? Like it's not I don't think any VC sits there and thinks, wow, this startup's coming out of this particular accelerator. That's fantastic. I really should pay more attention to that over that. That everything's on merit at the end of the day. And it comes back to those core themes of founders and the problem they're solving and the market they're going into. But yeah, I think all of us spend quite a bit of time running coverage across all of the programs.
Yeah. Actually, just quick yes or no. I mean, Ulric, do you guys watch pitch competitions or demo days?
Sure. Yes.
Yeah. Hannah?
Yeah, definitely.
Yeah, I've seen you at the StartMate ones when we were allowed to turn up in person. I was there.
Yeah.
We'll get back there one day. Let's ask another one, more tactical. Christy Kirk. Current rules of thumb, if there is any in Australia, for percentage equity and dollar amounts by round. So let's maybe start with the earliest first. So Grant, how much do you invest and what do you take for the average deal?
Like you might do an early seed round of, say, well, in our terms, probably minimum 750 up to $1 million, depending on your stage, and then that sort of goes through to about 2 million at seed. And in any of those stages is somewhere between at the low end 10% and up to 20% dilution.
Yeah,
it tends to be the frame on things. And as you move forward, depending on obviously your growth rate and your success and the value premium you're trying to get into your business, and that dilution sort of stays what we've seen between sort of that 10 up to 25, but generally 10 to 20% per round.
Yeah.
And you know, like, just so founders understand, like that's based on two things. One is obviously valuation, but also particularly in earlier rounds, VCs needing to be at a certain level in the cap table, basically. I think for us, our floor, which is pretty low actually, we look at a absolute minimum of 5% of a cap table when we go into it, and kind of sweet spots probably around about somewhere between 10 to 13, 14%.
And Grant, do you have a minimum, like, you know, because we've seen early stage deals where, you know, the founders already, you know, they've given too much away to staff or really early investors, and, you know, they're sitting at 60% ownership when we come in. Is there a bar, like how much should the founder have?
Yeah, we kind of look more forward on that. So like our sense is that if they're going to be below kind of, certainly if they're below sort of 20% after a Series A, that's really tough to back. They're just, you know, if things get really hard and you're relying on the founder, we just don't think they've got enough skin in the game. And it is a challenge. Like we've been on deals and lost a couple of them where the cap table was such where the founder had been diluted quite aggressively early for whatever reason. And they were hard conversations to have, where it was like, look, man, we got to figure out how you get back up in the cap table a bit, and sort of in between, you know, with the tax laws, you know, them not being, if you own over 10% of the business and you're providing yourself ESOP, you pay upfront tax on that. And then early investors not wanting to sort of, you know, let them top up shares, etc. It's just a challenging situation, to be honest.
Yeah. All right, I want to make sure that we're out here on time, so I suspect the other panelists would have a similar answer. So let's keep moving on. We'll take one more and then we'll do a poll and then one final question. So David Rames has just come in with a question. You know, I'm going to encourage honest answers here because I think I know what the answer should be, but I know the answer might be. Do you feel like you tend to make investment decisions more based on your heart or your head, Hannah?
Ooh, that's a really tough question. I'm often initially pulled by my heart, but the reason we have such a rigorous internal investment process, and it is very rigorous, we stick to it, is because we know that the heart often pulls in the wrong direction, and that we have to make rational decisions. And if we can align heart and head, that's the ultimate sort of North Star. We want to be backing companies that we are genuinely excited about, that we love the founders, that there's just genuine excitement about what they're building, and we want to be there for the long haul, and it makes sense from a rational decision-making perspective.
And Ulrich, honest answer on this one?
Yeah, we're a very data-driven fund, so we certainly lean that way. What I will say is we try to take ourselves almost out of the question of, do we think that this is a good idea or a good vision for where the industry should go, and actually ask the question, what if the founder is correct? And then what happens, and does that suddenly do a whole lot of things start lining up?
Yeah. All right, look, let's, we're down to the sort of final question here. So Claire, I think we should throw up this last poll. You know, we haven't talked really at all about COVID, and the reality is it is still out there. So this is the question for the audience. Do you think COVID has changed the way investors look at pitches? Yes, no, I'm not sure. It's just, we'll take an answer on that. And while we're waiting for the results, I will, you know, I'll ask this to all of you. So like quick answers if we can. So we're out here by 9. So how is COVID impacting valuations? That came in from David Waite. So Grant.
Look, you know, COVID's been obviously really impactful in different ways to different markets and different segments. Certainly valuations from our perspective have come off somewhat, and sort of in the range of probably pre-COVID, maybe around 20 up to 30% we've seen sort of, and that's more when firms have come to us and said, look, we're trying to raise a round and this is our expectation. So there's definitely, you know, valuation from our perspective, but then in some segments, like you look at online logistics and e-commerce, which are going absolutely crazy. People are like asking, because of the growth they're getting, really healthy valuations. So it's very sectorial, we find. I think the main things that we're probably changed in our approach a little bit is just, we're really focused more in sort of the sustainability of the unit economics of the business, and spending a bunch more time around how the market is behaving now and might behave in segments that have been impacted by COVID, because that goes to margin. Yeah. So that's probably the biggest thing that we've adjusted our focus on.
Claire, have we got the results from that poll? So yes is the overwhelming answer. Ulric, any thoughts on this? I mean, how are you seeing the world out there?
Yeah, look, from our perspective, and again, our focus is really seed stage. From our perspective, actually, valuations haven't changed. I think for later stage portfolio companies that are Series B, Series C, yes, certainly those companies are, generally speaking, having a tougher time raising. But maybe we're missing something. We just have a view that for the best seed stage companies, you pay what you need to pay, and valuations from our perspective have not changed. The one thing that for almost every company has changed that we often do ask founders in various pitch conversations is, how is COVID changing your go-to-market motion? So the sales tactics are obviously changing, and sometimes that's, you know, for the better, and sometimes that's it means that companies have interesting challenges that they need to problem solve for, depending on the industries that they're in. But really, it's go-to-market motions that are the main thing from our perspective that's changed.
And Hannah, really quickly, because we're really out of time, like any quick observations on valuations?
Yeah, I think just echoing what Ulric said, the best founders with really strong business fundamentals will always be able to raise capital. Yeah, they're not going to have an issue. There's a lot of capital sloshing around the system, and it was quite easy to capital raise with sort of shaky economics and not really durable competitive advantage. And I think it'll definitely sort of separate the wheat from the chaff, so to speak.
All right, well, my dog is telling me that it's time to get out of the room, so she's going to start barking and scratching any second. So maybe we should wrap up at that point. So thank you, Grant, Hannah, Ulric. Great to have you on the show, and for your insight. Audience, great job. Loved the chat. The chat room was going off this morning. So and thanks for keeping it nice and clean and constructive. So let me just do a quick final screen share, tell you what's been going on with us. Yeah, we have next week, the power of purpose. So impact investing. So we've got some of the best investors from there. So we've got Rachel Yang from Giant Leap, Jury Rosso from Driven, Joshua Roche from Human Ticks, he's a founder, and Kirsten Hunter from Future Super. So really good panel, you know, great topic, I think. So there is money to be made from impact-driven businesses. So let's get into that. Yeah, so that is what we've got. We've got a episode of Open the Pod Bay Doors just come out. So Sarah Nolet, who is the co-founder at Tenacious Ventures, which is an ag tech focused fund that just launched in, I think, January this year it came out. So she's amazing, great background, American lady. And yeah, I had a really good chat with her. So if you're interested in that, tune in. Thank you again to our national sponsors, Macquarie Bank, KPMG, AWS, and Farmark. As I said before, give them some love because we certainly appreciate their support and help. So that, ladies and gentlemen, is it. Maybe I'll sign off as Batman because there was a little Batman thing earlier. So from Gotham City, we are out of here.